There's hundreds of trillions of dollars of capital right now in the world that's locked up. The design of these instruments is opening up that capital to come into Bitcoin. This is the biggest opportunity for the entire market to bring new capital into the door, and it resets the cost of capital, in my opinion, the rest of the financial world.
We saw this with game theory throughout all Bitcoin. Perfect example was Vanguard and BlackRock, right? With the ETFs. You know, there's people who say that digital credit's competing with Bitcoin, and I couldn't disagree more.
Even though these products have been incredibly successful and had a lot of traction, we're still quite early.
I just want to hit on that trilemma. The trilemma of credit products is yield, volatility, and liquidity. Historically, any other credit product, you have to pick 2 out of 3.
So if I was to just summarize a little bit, if the audience was hoping for bullish sentiment, then they've come to the right panel. Good morning, everyone. The new era of Bitcoin financial engineering. Thank you for coming to this morning's panel. My name is Michael Howe. I'm head of strategy for Bitwise in Europe. And thank you to the panelists for joining us. Looking forward to the conversation. I think most of the audience is aware of who you are, so I don't think we need to do an intro round. But maybe when you're answering your first question, you can say a few words about yourself and your company just to orient everyone. What about you, Jeff? When you're speaking with investors, how do you position the value proposition?
Yeah. So for those that don't know me, I'm Jeff Walton, Chief Risk Officer at Strive. Strive is the 7th largest publicly traded holder of Bitcoin. We have 19,000 and change Bitcoin on our balance sheet, and we are the second global issuer of a digital credit product. Digital credit being a publicly traded security with a low volatility exposure to Bitcoin yield. Our instrument, SATA, S-A-T-A, pays 13% annually. So, Sam, I really like how you frame this. Really, there's hundreds of trillions of dollars of capital right now in the world that's locked up in credit instruments or equities or money market funds. And the design of these instruments is opening up that capital to come into Bitcoin. That capital never would have flowed to Bitcoin because of the risk profile, because of mandates, because of the architecture of the existing financial system. So the creation of these new instruments allows different capital pools to come into the Bitcoin ecosystem. And I think there's tremendous second and third order effects of these instruments being designed, and that's everything that could be built on top of the ecosystem as well, whether that be ETFs or DeFi projects or structured products that sit on top of the digital credit instruments. And we're yet to see what that also brings. So really, this is a new platform, and the fact that it is a perpetual security creates a new platform to build on top of. So really, I think this is the biggest opportunity for the entire market to bring new capital into the door, and it resets the cost of capital, in my opinion, for the rest of the industry, the rest of the financial world. Right? If there's new capital being allocated to a new credit instrument or a new fixed income instrument, it has to compete on a risk-return basis. And I think we can all agree that Bitcoin is the best instrument to hold on your balance sheet. So thinking about managing risk, the actual risk profile of these instruments is very appealing.
ETPs and ETFs gave institutions a wrapper they're comfortable with. Now we're seeing Bitcoin treasury companies, we're seeing Bitcoin credit alternatives. This second wave, what do they offer in terms of differentiated value propositions to investors?
Yeah, pleasure to join you guys. My name's Sam Callahan. I'm the Director of Research and Strategy at OranjeBTC. We're the largest Bitcoin treasury company in Latin America, listed in Brazil. To answer your question, I think the ETF was all about expanding investor access. It was a wrapper that allowed these institutional investors and individuals to get exposure to Bitcoin through a regulatory compliant wrapper that really fit right into their operations, made it very easy to have a Bitcoin security like that. Bitcoin treasuries are a little different. They're operating companies, they're capital allocators, they're using their Bitcoin balance sheets to transform Bitcoin's volatility into different products that fit investors' needs. So if an investor wants income or price stability, they can buy STRC or SATA. It's really unlocking these different pools of capital, providing Bitcoin-backed securities in all different flavors. So it's really about expanding even the access further to basically meet investors where they are. But it's important to understand that it's all backed or supported by Bitcoin, the pristine collateral, permanent capital. And so all of these securities really are differentiated from traditional products out there. T-bills, money market funds, private credit. That's what you should really be comparing these credit instruments. And these treasury companies can be thought of as financial engineering platforms, operating companies that are issuing these securities to the market, basically meeting investors where they are.
Yeah, I mean, if you think of the segments of investors out there, so many different sizes, different locations, geographies, and so on, so loads of different needs. What about you, Valentin? What are you seeing in terms of similarities, differences?
So I'm Valentin Kosanovic, Deputy Director of Bitcoin Strategy at Capital B. So Capital B has been Europe's first and is Europe's largest Bitcoin treasury company. And I will answer your question by saying that we are in the phase, since the Industrial Revolution, the highest phase of market asymmetry. We are in a phase where fiat money is inflating 5 to 7% a year. At any point in time since the 1960s, you can see at any point in time you are increasing over a period of 21 years, 200 to 400% of fiat money. There is a market asymmetry as well today with the AI, robotics, and so on, CapEx expenditure, which is, in fact, twice as much as the Industrial Revolution in terms of GDP equivalent. And all this wealth being created has to go somewhere. It has to go somewhere scarce. And the fundamental market asymmetry on which Bitcoin treasury companies are looking for is that the second best reserve of value, gold, because Bitcoin is the very best, well, Bitcoin is trading at a 90 to 95% discount with regards to the second best. So this is your market asymmetry. And Bitcoin treasury companies are focused on deploying capital markets instruments, equity, debt, digital credit, to capture this fiat entropy, which increases within an isolated system. This is the second laws of thermodynamics, and channel that into hard money. Bitcoin treasury companies are about using capital markets to provide convexity to investors. When you look at beta ratio for Bitcoin treasury companies, for Capital B, for instance, but it's the same for Strive, for Orange, you have a beta that is positive to the upside, which means that whatever Bitcoin moves, well, Bitcoin treasury companies move higher. And the lower convexity is also on the downside. And so you can understand that while Bitcoin treasury companies and digital credit products are issuing different lines of products for different lines of risk-adjusted returns and risk-adjusted investors to capture this fiat entropy and turn it into a hard asset. And I would say that the main difference with regards to ETFs is, and I think all panelists will agree, we at Bitcoin treasury companies understand deeply, fundamentally, that we are working for Bitcoin and not the other way around.
How about you, Ivo? You're deep in the Bitcoin space. What are your perspectives of this second wave of products that have been really successful?
Yeah, thank you very much. Ivo Kadlic, my name. I represent DAIS, the biggest cryptocurrency exchange in the Czech Republic, known as Anycoin over here. What I see within the first wave of ETFs, it fulfilled what's supposed to fulfill. It brought the traditional finance into Bitcoin. So the retail is there, the money is there, and basically it was approved to traditional finance that the demand is here. And right now they are going to build on this, and they are going to build it on Bitcoin, which is crucial from our point of view, because it's not wrapped Bitcoin anymore. It's Bitcoin itself. And right now they are looking more into depth, what can be done with Bitcoin, yield, collateral, etc. So from our point of view, Bitcoin side of view, it's great that the traditional finance are going more into depth of this world. And we need traditional finance, because if we want to bring the worldwide adoption, it cannot be done without the traditional finance. So it's kind of merging all together, and yeah, looking forward to where it will bring, what it will bring over here.
Yeah, you mentioned traditional finance, really interesting, right? What are we talking about here? Are we talking about the beginnings of something that will ultimately disrupt TradFi? Or is this something that's being built in parallel and will coexist with what we think of as traditional finance? Valentin, what do you think?
Well, we have to first understand what is disruption. Is this something, a concept completely novel? Well, in fact, Michael, digital credit is the old display in the book. You can go back to the medieval era, to the financial revolution, industrial revolution era, with a product that was called back then perpetual rent, rente perpétuelle, that was even invented by English, by the UK, and then adopted by French entrepreneurs. That was basically a principle that we are going to run up for forever, and paying a rent, perpetual rent on that, which was à la vingtaine, à la douzaine, which means 5%, 7% interest, perpetually. And so with this, those entrepreneurs, what did they do? They accumulated silver, they accumulated gold, and down the line, they became the Banque de France and Banque d'Angleterre. So you have to understand that, in fact, digital credit is also taking the opportunity of channeling this volatility of Bitcoin, and in fact, scrapping the first volatility to provide access to thousands and thousands of institutions out there that are craving high return, low volatility, and high liquidity, which you cannot have with regular bonds. You are looking at high yield junk bonds for Europe, for example. They are starving high yield products. The high yield index is showing 5.7% interest last time I checked, with a thrice liquidity and volatility as SATA and as Stretch. This tells everything. And so what you can see is that obviously there's a market asymmetry, of course, but there's a duty for banks to survive, to adopt digital credit. And what I would say is, a lot of analysts are saying that the total addressable market for digital credit and digital equities, and especially digital credit, is a 300 trillion credit market. Well, Michael, I beg to differ. I believe this is consequently higher. So I made the case on bonds, I made the case on credit, okay. But why would you invest in the S&P 500 that yields, but with a volatility that is going through the roof compared to digital credit instruments? Well, digital credit is better. And so you hit the $100 trillion equity market. And I'm stretching that. Why would you invest in real estate, where you can get your house seized and regulations and so on, you have uncertainty? Digital credit is better. So the total addressable market for digital credit is, in my view, $1,000 trillion. And again, my conviction is that in the next 10 to 15 years, well, digital credit is going to take 15 to 20% of that, but let's be conservative and take just 1%. Well, it's 10 trillion. STRC is 10 billion today. That's the case. That's your case for the next 1,000x. And I'm being very conservative here. So, and I mean, banks understand that. Obviously, banks by design are slow of adopting the revolutions and so on, because they have long decision processes and allocation processes. BlackRock advised 1.5 years ago to their advisors to allocate 2 to 4% to Bitcoin. It's not the case today, so they are slow by design. But I can guarantee you that what I saw back in the days when I was working at Accenture, where there was a career risk of not considering Bitcoin, will be in the next 3 to 5 years a huge career risk for the bank and the institution C-levels that will not have considered developing, offering, distributing digital credit and digital equity by Bitcoin treasury companies to their clients.
Yeah, just to add off that, I think what he's getting at is these instruments are just better when you compare it to traditional
Yes.
alternatives. If you look at the broad credit profile of the asset coverage, not only is the asset itself a disruptive technology and pristine collateral and the best form of money we've ever seen, but beyond that, look at the asset coverage, the liquidity profile, the duration, all these things together make it very compelling. So it is disruptive because everything else is just not as good. And so it's going to take market share. There's going to be a ton of demand for these products. But in terms of how disruptive it is, it kind of depends from institution to institution. They can also choose to embrace these products and offer a better service to their clients. These banks, for instance, they offer 0%. I mean, it's like tragic. And they wonder why they're so worried about stablecoins earning yield. It's because they've offered nothing for their clients. What they could do is embrace digital credit, strip the risk down to zero. What Michael Saylor keeps saying, hey, will somebody do this? Have an account, bank account that offers 8% zero vol backed by STRC or SATA. Those institutions are going to outperform their peers because they're offering a better product for their clients. We saw this with game theory throughout all Bitcoin. Perfect example was Vanguard and BlackRock, right, with the ETFs. BlackRock embraced it. Vanguard said no. Eventually, Vanguard capitulated. BlackRock had the most successful ETF of all time. And so I think you're going to see this similar thing play out with digital credit. It doesn't have to be disruptive for every institution. It's just those that embrace Bitcoin-backed securities, Bitcoin-backed credit are going to outperform their peers.
Yeah, these things are massively disruptive. I think you hit the nail on the head. The risks are significantly different. You think about the physical risk in the real world. Real estate has physical risk. You think about private credit. You're taking on corporate opaque risk that you don't know what the cash flow looks like. You think about when you underwrite traditional credit, you underwrite cash flows into the future. And so now we've got this really disruptive technology called AI. I don't know if you guys have heard of it, but it's completely disrupting what future cash flows look like at corporations. So when you have a probability umbrella looking at future cash flows and your uncertainty widens, that changes how you view credit instruments. And now underwriting that relative to assets that are already on the balance sheet that are appreciating greater than the money supply is increasing, that relative risk profile is actually very wide. I'm a little skeptical on banks actually adopting this and offering additional products. Just thinking, I think there's going to be a longer tail of additional old school institutional adoption, which is very similar to the timeline with Bitcoin, right? There's really big opportunity for retail and smaller companies that are a little bit more flexible to adopt these things and start developing the new future that we want to see. So I think they're massively disruptive. I think largely and broadly the risk is completely misunderstood and not analyzed enough yet. And I think that will evolve as the products continue to mature.
Yeah, absolutely. So if I was to just summarize a little bit, if the audience was hoping for bullish sentiment, then they've come to the right panel. I love it. Really interesting. One of the comments yesterday in a discussion with Michael Saylor was about the different types of investors he's seeing. And by and large, I don't know if it's true in every case, but according to Michael, by and large, the investors in STRC are quite different from those who are buying Bitcoin directly. So two quite distinct investor segments. So reactions to that, reactions in general about where demand for these products, this new wave of products is coming from. Anyone want to take that first? I'll open it up.
Yeah, I could take it. I think there are fundamentally different buckets and pools of capital. And you think about this, so my background being in insurance and reinsurance, you're thinking about duration of capital is very important if you've got to manage liabilities of an insurance company balance sheet. So same thing happens with humans and families and corporations. You think about, I want to store my money. If you wanted to store your money for a long time and didn't want to use it for 10 years, 15 years, maybe Bitcoin and cold storage makes a lot of sense. If you had short-term duration liabilities on the horizon, maybe something like digital credit makes a lot of sense. So, and we've seen this. I've seen it in talking with people, several of the people here, and talking with investors in the US. The digital credit products are very interesting for people that are looking at the short-term and moderate-term duration instruments where they can park short-term capital and earn a little bit higher yield than they would as an alternative of putting in a bank and earning zero, which you're also taking risk in a bank. You can take this risk and earn a higher yield relative to other moderate duration instruments. Just me personally, like I bought a house, I don't know, several years ago, and I had this pool of money, and it was going to help me with my down payment. And I was really struggling between, like, do I put this money in the S&P 500? Do I put it in a bond that's illiquid? Like, where do I store it for like 6 months? I know I'm going to buy a house 6 months from now, and there just wasn't a great option for me. And so I ended up just holding it in cash. Meanwhile, I got run over by the stock market going up 15, 20% in those 6 months. But I couldn't have taken that volatility. I couldn't have taken the chance. So this, to me, seems like a very good, like, moderate duration instrument where you can start to wrap your head around it. I'm not saying that it's an identical risk to a money market. It's an alternative risk with a different liquidity profile, a different risk profile, and it's worth additional analysis. And as these continue to mature, I think that thought process will evolve. I mean, humanity has never experienced anything like this before. Right? This is a new way to interact with money. This is a new way to interact with capital. Thinking about an instrument that's liquid. Yeah, I'm not going to get my principal back. This isn't a debt instrument. But I could start to think about the pool of liquidity being my way to get principal back. I could start to think about the timing of the liquidity, like when capital comes in on the record dates. I could start thinking about maybe I should time an exit of this position when that period's coming in, when there's significant increased volatility, or not volatility, increased volume. So this is all evolving. Everybody's building this at the same time. Everybody's talking about how to start using these things. These are novel, and I wouldn't be scared because they're novel. They're just different.
Valentin, what about you? Do you see it similarly?
Yeah, I was speaking about market asymmetry. I believe there are different products for different risk profiles and different mandates. There are funds that have the mandate of absolute low volatility fixed income and that cannot handle the volatility over a period of 1 month, 3 months, 6 months. So I agree with Jeff. I mean, digital credit solves the investor trilemma, the fixed income investor trilemma, and also the short to medium term risk adverse investor trilemma. And as you can see, obviously digital credit has had a tremendous success as of today in a bit more than 1 year. But it is with less than 1% of the global population being aware that digital credit exists. And as Jeff said, and I can just concur, well, it's a new way at looking at not only financial products, but at looking at money. You can understand that there is now a way to take advantage of the fundamental market asymmetry of fiat money literally going up 7%, 9% a year, and even more exponentially. And so the fundamental thing that institutions and investors, early investors that are in fact front-running the 99.9% of the rest, that is going to come eventually, is the fact that you can understand that low volatility, high income product is for everyone.
Yeah, real quick, I just want to hit on that trilemma, right? Okay, the trilemma of credit products is yield, volatility, and liquidity. Historically, any other credit product, you have to pick 2 out of 3. If you want higher yield, you got to give up either volatility or liquidity, and vice versa. You could do the same thing. You get 2 out of 3. Now, these new perpetual preferred equity instruments backed by Bitcoin, they have all 3. It's the holy trinity. If you're able to get all 3, that's a really appealing instrument, particularly if you're looking at managing a modern portfolio of, improving your return and reducing your risk.
Yeah, I agree, Jeff. And if I have to just add on that, the fundamental asymmetry on that also is the risk perception. In fact, investors today of digital credit are front-running the credit rating agencies.
Correct.
That, I mean, still have hard understanding, grasping the fact that, well, you have collateral and, oh, surprise, you can use it. Well, in fact, when you look at digital credit instruments there, the moment where credit rating agencies understand the model, understand that, again, collateral is actually collateral, and that you have 40 to 50 years of dividend coverage ratio for the major Bitcoin treasury company, for Strategy and SATA as a very strong coverage ratio, with compared to, for example, the Max 7. Max 7 is on average, if you take cash and being generous marketable securities, you have on average 5 to 10 years of coverage, and that's amazing even for them. So the moment they will understand that, well, capital will flow into digital credits at unprecedented scale, because it will then enter the mandate of those funds that are fundamentally risk-averse and that have just the mandate to invest into high-grade, high coverage ratio securities. And this is an amount of capital which can sustain the thesis, as I said, the thesis of the 1000x, and in a much shorter period of time that most can expect.
Yeah. I mean, I think it's a really important what Jeff said about duration, because there's people who say that digital credit's competing with Bitcoin, and I couldn't disagree more. I spend most of my time teaching people about Bitcoin, but it is a long duration asset. And so over the last month, it's dropped 20%. That's just a reality. And people have bills to pay. They have buckets where they have short-term cash needs. And when you compare it to, say, other options available, first off, many don't exceed the rate of monetary inflation, so 6.7%. So when you buy money market funds, T-bills, you're taking a guaranteed loss in your purchasing power. But you're really trying to optimize not for return on capital, return of capital. And so you want price stability, you want low volatility, but you're not going to get that from Bitcoin, unfortunately, over the short term. It's like what Jeff was saying with the house. And when I look at like T-bills, like I don't feel like lending my money to a government that's highly indebted, that keeps wastefully spending money. I would rather support a company that's building on Bitcoin. And I give, when I buy Stretch, it gives Strategy more capital to turn around and buy Bitcoin, which is what I hold my long-term savings in, which is what I'm building our entire company around, that asset. And so it makes sense for me to try to optimize for Bitcoin adoption by adopting every single Bitcoin-backed security for all my different duration needs across my entire, savings and short-term needs. And so people need to start separating that and thinking that, hey, you can educate people on digital credit and Bitcoin. They serve different purposes, but they're all accretive to the underlying asset and Bitcoin adoption broadly.
They call that alignment of incentives.
Yeah, there you go.
Yeah, I just wanted to conclude maybe this discussion. Basically, I talked to 5 major banks over here in the Czech Republic, and every single one of them is going a totally different direction, which is amazing, like one is Bitcoin investment for retail, then stable coins, then blockchain technology being involved within their systems. So it's amazing how even in the traditional finance, 5 different banks going 5 totally different directions. From my perspective, it's a good thing, because they are discussing it, they are dealing with it, and they want to do something about it, which was not here 2 years ago. 2 years ago, nobody wanted to discuss anything, even opening the account with me over here in the Czech Republic for the cryptocurrency exchange. Now it's totally different. There are specific teams learning about Bitcoin, discussing Bitcoin, and discussing with the management how to involve Bitcoin within their infrastructure, which is amazing, and it's happening, which is a good thing.
I mean, just to build on that, at Bitwise, of course, we're in a lot of conversations and have been in the space for a long time. And one reflection that seems clear to me is, even though these products have been incredibly successful and had a lot of traction, we're still quite early. And you see the Bitcoin price action, which has been depressed recently, hasn't seemed to really materially slow them down. So I think that's really exciting for the future. Should we change gears a little bit and talk about the distribution rails of these digital credit alternatives? Valentin, what are your perspectives?
Yes, so it's very interesting because, as said Jeff, I mean, it's a new way of looking at money, but it's also a new way of looking at distribution, frankly. You have seen the blossom of several ways of distribution, from TradFi to DeFi to so on and so forth. For instance, ETPs. You follow the path of least resistance. ETPs like 21 shares are proposing access to digital credit at scale, and this is a very successful product for them. They have all interest in the world to release those products, and banks, in fact, have all the interest in the world to release those products. But what is a very interesting use case of digital credit in terms of distribution is through the layer 3, tokenized digital money. You see the example of Apex, of Saturn, and so on and so forth, that in just a matter of months reached $700+ million of AUM. This is crazy. And in fact, every DeFi protocol, if they want to have the opportunity to grow, to develop, and to have ways of integrating fiat entropy and integrating capital and turning it into hard money, well, digital credit distribution is the way. And in fact, I will go further than that. I believe that actually digital credit is giving all the other chains a purpose to live. I can imagine a world where Solana, Ethereum, Arbitrum, and so on and so forth will, in the longer term, be the very best channels of digital credit towards Bitcoin. And that's good for Bitcoin as well. And so in this regard, I think that so the DeFi ecosystem is one thing, but I get that, again, banks and financial institutions are slow, but I really see the case for them to offer digital credit products through white labels. I've worked with many banks before at my previous job at Accenture, and I saw a very strong appetite for taking technology and innovation from third-party providers and offering them to their clients. Well, this is the same way. This is the case for digital credit distributed by banks, because imagine banks doing a bank account or simile bank account, a fund, that pays, let's say, 9 to 10% interest a year, and that is powered by digital credit on the background issued by European, US, Japanese, and so on and so forth, Bitcoin treasury companies. Well, this is your case of the average banking client, retail clients that has no clue about digital credit, of being exposed to digital credit and being exposed to Bitcoin. And my thesis is that in the next 5 to 10 years, there will be more people exposed to Bitcoin through those rails than through Bitcoin itself. And so if this thesis is correct, well, Bitcoin is bound for an era of mass adoption that is hard for the human brain to comprehend.
Really interesting. So you mentioned sort of visibility of these products. I have a friend, he's a wealth advisor in Silicon Valley, and as of Tuesday had not heard of STRC or any similar product. So there's still a lot of awareness to be built on, which in many ways is an opportunity and quite exciting. We shouldn't forget, I guess, how new these products are and how innovative they are. So in the short lifetime of them, what have you guys learned about going to market, distribution rails, and so on?
Yeah, look, the world is moving so fast, and it's quite literally whiplash. I mean, within the last month, so Strategy has announced that they're going to semi-monthly dividends here, and we have announced that we are going to be the first security ever to pay a daily dividend. So you've got two issuers. Literally, dividends have never been paid faster than on a month cadence ever before. So we've got two innovations coming at the same time. Strategy, I don't think, has intentions to move to a daily dividend in the near future as well. So how does that flow through? So that is going to flow through to the DeFi ecosystem, that's going to flow through to wrapped products in the TradFi ecosystem, and it will start to infiltrate several different areas very, very quickly. And you think about DeFi, I mean, what you mentioned there, this should theoretically eviscerate all of the other yielding crypto coins. Just completely eviscerate them. So this is bringing capital that was historically going to go to, altcoin number 300 is going to come into some sort of wrapped digital credit product because it's got a better risk profile. And the fact that the dividends are moving more frequently actually improves the risk profile of these layer 3 instruments and how it can potentially be distributed and its ability to infiltrate the rest of the world. So I think that's going to move very quickly. The innovations and the second and third order effects on top of this is going to be complete whiplash. And we will continue to see innovation after innovation over the next several months.
It was really interesting thinking about DeFi, just casually looking at the yields there and comparing them to the products, on offer. I mean, it's dramatically different and not competitive.
It's more about the risk. I mean,
That too.
it's very difficult to quantify the protocol risk throughout DeFi. I think people are recognizing that, especially with the emergence of AI to find these exploits and vulnerabilities throughout the complexities of DeFi. It's really difficult to understand the tail risk. So you could argue that the yield should be much higher and that these digital credit products, they should be lower because they're supported by Bitcoin and they're actually over-collateralized with a transparent balance sheet that you can check in real time. And so they should just be the market will start to understand this over time. But like Jeff said, with the introduction of these new Bitcoin-supported digital credit products, it really is disruptive for DeFi, especially if they're paid on a daily cadence, because that fits into how these DeFi protocols like to work. More frequency, the better.
And the liquidity is just so incredibly important. And as it moves to tokenization and these equities start to get tokenized and they're trading more frequently, 24/5, 24/7, the risk profile of these instruments is just so incredibly appealing because you can calculate it 24/7, 365. And the more frequently the dividends are paid, the less risk that the layer 3 has to take on in risk provisioning around liquidity. So the name of the game right now is building liquidity as much as humanly possible in all of these instruments, because that facilitates an ecosystem for layer 3s to be built on top of that. And additionally, on top of this, I mean, thinking about tranching and structuring different products too, right? You could take this perpetual instrument. Bitcoin is a perpetual. Digital credit is a perpetual. So we've created a structured instrument off of Bitcoin. And now structured instruments are being created on top of the digital credit perpetual instrument. So you could start to think about, now I've got a senior tranche that may be even less volatile than the perpetual itself, and I got a junior tranche, and maybe that's significantly more volatile, but it's got a higher yield associated with that. And I think the demand for both of those instruments is incredibly high. I think that's how we start to approach rating agencies adopting these instruments as well, because they can start to conceptualize a term product if it's in a traditional financial wrapper. And I think that's where we're going.
Fantastic. Just keeping an eye on the time. We are out of time. Thank you so much. Really enjoyed it. Really enjoyed the optimistic and bullish sentiment. And I think a lot of innovation to come from all of your companies. Looking forward to seeing it.
Yeah, thanks for having us.
Thank you.
Yeah,
Thank you
cheers.
very much.
Appreciate it.